Let me get started with that firmer language that we saw regarding on how long QE would last. Substantial further progress. What does that mean to you?
Well, it means to me that you get through the valley of the next few months where the economy is going to do very poorly because the pandemic's raging. You're going to see a strong rebound in economic activity in the second half of the year. And then I think after that, the Fed will probably conclude that they have made substantial further progress. And then only then will we start to see the pace of asset purchases slow as the Fed begins a taper program, probably in 2020, 2022.
We didn't really get an exact definition of what inflation and unemployment rates would actually trigger action. Do you get a sense of where we're headed here?
Well, they've given us very concrete guidance on what will lead to a rise in short-term interest rates. They basically said you have to be at maximum sustainable employment, you have to be at 2% inflation, you have to be confident that inflation is going to rise above 2%. They haven't given us quite a specific language in terms of asset purchases, but we know that the asset purchases are going to end before the Fed raises short-term interest rates. So I think, as long as the Fed is pretty confident that the recovery is well in hand, late this coming year, or sometime in the first half of 2022, that's when I think they'll start to talk about tapering that pace of asset purchases. And then after the asset purchases are tapered to zero, they'll wait to see when they actually achieve their inflation and unemployment objectives.
Well, that's awfully far down the road. It's interesting to me that
Yes,
this is so much in focus for the bond market, although investors have to look ahead. So let's look at right now, Bill. How does the economy look to you, and how badly does it need more fiscal stimulus? Powell is very circumspect about how much he said about that today.
Well, I think he was very clear that he thinks that more fiscal stimulus is appropriate. Where he was very circumspect was telling Congress what form the fiscal stimulus should take or the size of the fiscal stimulus and its duration. I think the Fed understands that the economy is going to be quite weak over the next few months as the pandemic rages and social distancing increases. So we're probably actually going to have a very tough winter. The Fed sees fiscal policy as a bridge to support incomes to get us to the other side when the vaccines are broadly distributed and people are immunized. And then the second half of the year, we'll probably see a pretty powerful recovery. But the Fed basically realizes that there's only so much monetary policy can do to support the economy from here, given that financial conditions are already very accommodative and interest rates are already very low. So what they want to see is something on the fiscal side to provide support to income to get us through that valley that we're going to face over the next few months.
The Fed was pushed in a number of different ways about, their tools. How much more can you do with bond purchases? Why not do more now? What's the answer for you, Bill Dudley? If the Fed decides to start buying more bonds, will it help them reach their goals faster? Will it push yields down if they're rising?
Well, the Fed could clearly do more. They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates. But that's really not the problem facing the economy right now. The level of interest rates is not holding the economy back. I mean, we look at the housing sector, it's doing very well. You look at consumer durables, they're doing very well. So if the Fed did more, it really wouldn't have that much consequence for the trajectory of the economy. And I think that's why the Fed's holding off. They know that they've already accomplished what they want to accomplish in terms of supporting financial markets, making financial conditions accommodative. And, I think at this point, the only way they're going to escalate is if things turn out to be distinctly worse than what they anticipate in coming months.
What about if we get things substantially better next year, especially if we see a spike in inflation? Is that a concern at all at this point?
Well, I think that Chair Powell was asked about that at his press conference. And he said, well, it's important to recognize that even if prices go up in the second half of the year as we get this strong rebound in demand, that's a change in the level of prices. That's not necessarily an inflation trend. So I think the Fed's saying that they'll look past the first little bout of inflation if they think it's just due to a readjustment of demand. My own view is I think the risks on the inflation side are a little bit higher than what some people think, both because there's a lot of dry powder. If you look at the personal savings rate in the United States, it's around 13%. It was at 8% going into this pandemic. So I think when we come out of this a period of darkness in the winter, we're going to actually see probably a pretty strong recovery in the economy in the second half of the year. And you probably are going to see upward pressures in prices that are maybe more substantial than what people anticipate at this point.
Especially if you consider the fact that President-elect right now is talking about more stimulus on top of whatever we get this week around February. Do you think there's a need for that? And what would that do to the macroeconomic picture that we've been talking about?
Well, assuming Congress enacts something close to $1 trillion package over in the next week or so, I think that's probably sufficient to provide that bridge to get you to the recovery in the second half of the year. I think the important thing is not to pull back the fiscal stimulus. You remember during the great financial crisis, we got a big fiscal stimulus package, and then we pulled it back in 2011, 2012, and 2013, and that really retarded the pace of economic expansion. So it's really important that fiscal policy remain, somewhat supportive to economic activity as long as the unemployment rate is elevated.
Bill, I want to come back to this question of inflation because you wrote an op-ed for Bloomberg recently where you said people and markets could be in for a surprise. So, and Jay Powell today once again said, oh no, disinflationary forces are in place. The Fed you can't get to 2% for 2 or 3 years. What about inflation? What's going to push it higher when it hasn't gone up for so long?
Well, the number one thing would be a much stronger recovery than what people anticipate. And I think there's a real chance of that because there is so much dry powder. And the fact that you're getting another fiscal package that's going to actually support economic activity over the next few months. Second, I think that the reality is, the Fed is not going to stand in the way of inflation. I mean, they basically have said to us very clearly, we're going to keep interest rates low until we see inflation, not just at 2%, but until we're confident that inflation is going to climb above 2% for a sustained period of time. So I think the Fed's, has said they're going to be very slow to tighten monetary policy, which is another reason why inflation could become more entrenched.
So inflation becoming more entrenched is one thing. Getting it up to 2% and keeping it above 2% is quite another. It has only done that once in over the past decade. So when you talk about inflation rising, are you talking about the kind of increase the Fed wants to see? And at what point does that become a problem?
Well, I think that they want to see higher inflation than what we have right now. I mean, they're shooting for 2% inflation on average using their preferred measure of inflation, the personal consumption expenditure deflator. Right now, we're running well below that. I think they probably want to overshoot that by maybe a quarter percentage point or a half a percentage point for a couple of years. So they're shooting for maybe 2.5% inflation, 3 or 4 years out. That's what they'd like to see. That's not what's priced into the financial markets today. You look at the break-even inflation rate, looking at nominal Treasury securities versus TIPS, the break-even inflation rate on a CPI basis is 1.9%. So the market is really basically saying that the Fed is not going to succeed in what they're trying to do in terms of pushing inflation up. And I guess I'm more confident that the Fed's going to succeed.
So if that's the case, and you watched the bond market for a long time, from your years at Goldman Sachs to running the open market desk for the New York Fed to being the New York Fed president, where you have to watch this so closely. 10-year note above 1%, 10-year note heading for 1.5%. What's going to happen if your inflation outlook comes true?
Well, in the near term, I don't think you're going to have much of a backup in bond yields because the market would view that if bond yields were to rise significantly, the Fed would increase the rate of asset purchases to push bond yields right back down. So I think the risk for the bond market is really not in the next 6 months or even 12 months. I think the risk for the bond market is when the Federal Reserve starts talking about tapering the pace of asset purchases. You remember back in following the great financial crisis, the so-called taper tantrum, when Chair Bernanke just started to muse about the time when asset purchase taper might begin, and bond yields rose by over 100 basis points. So I think there is a risk of a taper tantrum. Once you've had a very, very accommodative monetary policy in place for a very long time, once you start to signal that you're starting to pull away from that, that's a big regime shift, and that's really when we have to worry about a significant rise in bond yields.
And I think much closer to home is this question of corporate defaults. Jay Powell said everything looks pretty good. But what about the smaller corporations? What about medium-sized businesses? The group of 30, you're very familiar with that group, you've been part of it, put out a report saying that liquidity crisis has been handled. A solvency crisis is coming next year, and governments and central banks have to get ready now. Are you concerned about that? Should Jay Powell be more concerned about that?
Well, I think there are going to be a lot of smaller businesses that fail. I live in Cranford, New Jersey, and the 2 biggest restaurants in town have already gone under. So I think you're going to see a lot of damage in the smaller businesses that support, leisure and hospitality. And these companies don't have the ability to go tap the capital markets to provide that bridge funding to get them to the recovery period. So I think there definitely will be a lot of damage to smaller businesses. Now, the Fed has tried to address this, and the PPP program tried to address this, but the Fed's program, the Main Street Lending Program, really hasn't been very effective in getting dollars out to medium-sized businesses.